Talk more about the markets and bring in Jason Trennert, Chairman and CEO of Strategas Research Partners. That's a Baird company. I don't know whether you're feeling any more optimistic or any more bullish. We had a Piper Sandler technician on who said 4,600 on the S&P. We'll get through 4,200, and this is more than just a bear market rally only to retest the lows.
Yeah, I think, technically, certainly anything can happen. That could happen. I think from a fundamental perspective, to get really bullish from here, you have to essentially be betting on things that have never happened before. So you'd have to be betting on the Fed tightening by at least 500 basis points and you're not having a recession. You'd have to bet on some sort of fiscal austerity not impacting the overall economy because the bill has come due for all the fiscal profligacy that we've had. And so from my perspective, I'm still quite cautious on the economy and the markets. And a lot of it comes down to the fact that, as I said before, the bills come due in terms of QE. The Fed, it may have stopped tightening. I would say that's very likely. But the idea that the Fed's going to start easing anytime soon, I think, is very, very unlikely. And as Mike said, you have a window here between the last tightening and the first easing. The irony, though, is that after the first easing, if you get a recession, the market tends to get tagged pretty good because of the lags involved in monetary policy. By the time the Fed starts easing, you realize that you're actually in a recession. So I'm still cautious that we're defensively positioned in the portfolios that we oversee.
Why is there sort of an old saying that you should buy right at the bottom of a recession? And how long would the recession be? How do you time it? Because a lot of times that's a time when stocks bottom. Right?
It's true.
And the recession is obvious to everyone.
Right. Well, and I would say, though, Joe, there's no sense that we're in recession right now. There's never been a bear market which bottomed before the recession, and that's likely what people who are bullish right now, they're saying that the market bottomed in October, and now people are looking to 2024. I'm saying I don't really see it that way, because in every instance the market bottoms after the recession starts. I don't think we've quite started yet. There are some cracks that are showing. The last man standing in terms of the economy, which is not insignificant, is labor and the employment picture. Claims are starting to move up, but the unemployment rate is 3.4%. Right. There's still a shortage of labor, so it's hard to get a recession when you have the employment at this level. But I think as corporate profits continue to roll over, I think you're going to see higher unemployment.
And we need to go below the October lows, or we could revisit them and that could be the bottom.
I think you could revisit them and that could be the bottom. I think, we're using $200 for S&P 500 operating earnings this year. If you put a 16, 17 multiple on that gets you 3,400. That's around where we were in October. But I just think right now at 4,200, you're betting on something that's never happened before, which is that investors look through a recession. And I get that question all the time. This is the most anticipated recession of all time. Why wouldn't investors look through it? I would say, based on my experience, once the bullets start flying and earnings estimates start to come down, you start to get negative economic news, people are not quite as willing.
Effect.
Yeah, you start to wonder whether things will just get worse.
What if they're in a recession?
It's possible, Joe, but I think it's, again, the only time I can think of where we didn't get a recession when the Fed tightened this much was 1994. But I would say this is very different than 1994. That was the kind of the immaculate tightening, if you will, on the part of the Fed. They were able to tighten without causing recession, but they didn't tighten as much as they're tightening now. And I would say inflation is still an issue. Inflation's still 2 to 2.5 times what the Fed wants it to be, even if they say it's okay at 3, which I think they'll do, because I think, frankly, if they actually pushed it to 2, they would cease being an independent entity. They would probably be a committee in Congress or something at that point. But I think that I think they're going to continue to stay tight for a while.
Let's just talk about something else that's never happened: defaulting on the nation's debt. You think it's fair to look through that to say it may be messy, but they'll resolve it?
I think, Becky, I think that's fair to look through, because we've, I don't know how many, everyone knows this, you probably know the statistics off the top of your head, but we've raised the debt ceiling 120 times or something over the last 100 years. What our view, that's a little bit different, though, is that The problems in terms of the liquidity actually coming out of the market happen after the debt ceiling is raised. One of the things that you've seen is the Treasury's general account has been drawn down very dramatically as we hit the debt ceiling. So in many ways, the federal government has been providing liquidity to the market. The irony is almost like the SPR. At a certain point, that Treasury account has to be refilled, and that'll happen after the debt ceiling rises. So that's probably the most non-consensus view that we have, is that the irony is that this is actually an okay time in the second half of the year when the Treasury actually has to refill their savings account. That's when the market and the economy could be more at risk.